Hello, this is Steve Sinangelo again from the SRS Rock Report, and today I'm going to do a quick update on the continued saga of the stock market leverage and insanity that is now reaching nosebleed levels. And you folks that had the wonderful experience of purchasing a ticket in one of the larger, let's say, football stadiums where you get to sit way up, they call them the nosebleed section. Well, this is where we are. This is the nosebleed section for the Dow Jones Index. And front row seats were here back when the Dow Jones in 81 was trading at 1,000. And now we're way up here. We're at over 26,000. Americans feel a lot wealthier today because they see bigger numbers, but it's all an illusion. And so this big arrow is where I see the Dow Jones heading over the next few years. And we've got 2 years. And you can't actually predict when it's going to happen because, could the stock market go to 27,000? Could it go to 30,000? Anything's possible. The problem is the leverage and the margin continues to go to more extreme levels. And then that just makes the crash even more violent. It's not a good thing for these values to move up. People think, well, I'm getting richer. No, it's a very temporary basis. And I'll tell you why it's temporary. These next few charts I got off of several articles on Zero Hedge. This is a good one because it shows what happens when consumer confidence gets to a high, then the personal savings rate of Americans falls to a low. And that was in 99, 2000. We had the crash. So consumer confidence fell and then it recovered. And then the same thing happened. We could see this history, this cycle repeats itself. And as the consumer confidence increased, personal savings moves down. And now we're seeing it once again. And this time we're moving up. Consumer confidence is starting to reach another record high. And personal savings now is moving to a low. Now this chart is done by Chris Hamilton. I actually know Chris, spoke to him on the phone once. He does some excellent work on the U.S. economics indicators. And this is one of them. This is U.S. household net worth as a percentage of disposable income. And as we could see in quarter four, 99, it was 611%. Well, unfortunately, that's when the markets crashed and the household net wealth fell. Well, this was the same thing with the personal savings. When the household net wealth was peaking, the savings was also at a low. And then we had the opposite. And then again in the quarter one of 2006, it reached 652%. That is the household net worth. And it peaked and it crashed again after the 2008 U.S. housing and banking crash. Well, Americans don't have a long history, or they don't remember things for a long period. So we make the same mistakes over and over again. So here we are. It's quarter four, 2017, and the U.S. household net worth is at a stunning 685% of disposable income. And as we could see, the personal savings rate is now coming to another low. So that's not a good sign. Actually, out of the three charts, this is my favorite because it tells you just how insane we've become. This is the Conference Board Consumer Confidence expectation of stock market prices increased. Well, we are at a record high at 51.6, and you can go all the way back. There are no 50s. Matter of fact, the highest was probably in the 47, 48 range. But here we are. Americans think stock prices are going to continue to increase. Now, I posted this chart in one of my articles, and I'd like to discuss it because there's been some interesting information about the data in this chart. Now, the red line is the NYSE margin debt, and it's the New York Stock Exchange margin debt. It's the traders' margin debt. And we can see a clear indication, a parallel trend, that when the margin debt of the traders peaks, so does the S&P 500, which is in the blue line. And as the margin debt declines, so does the S&P. And then again, we see another movement up to another peak here. And let me tell you, as of the last figures that were put out it was 580 billion in NYSE margin debt, and it's moved right up along with the S&P. Back here in 2007, before the crash, it was 450, and in 99, 2000, it was 400 billion. So we're seeing another movement up, and this is not sustainable, but it gets even, I think it gets even worse. Now, I actually contacted, let me go back really quick. I contacted the Advisor Perspectives website that puts out these articles as well as these great charts, and I asked them about the information. And I found where they got the information from, did my own research, and this is it. These figures here are what they make those charts. And right there, the NYSE margin debt is 580.9 billion in November. I wanted to see if they updated for December, and they haven't. But I did see this interesting red quote here, headline. Let's say it's I guess they're basically it's a warning. NYSE advises customers that the NYSE margin firm margin data will no longer be updated after December 2017. Similar data reflecting all firms, not just the NYSE member firms, may be found at this link, and it's FINRA. So they have not published the NYSE margin debt for December. I know it's going to increase. So I went to this link here, and I'll show you what I found. This is FINRA. FINRA is the Financial Industry Regulatory Agency. And what they're showing here is all margin debt, I guess all the exchanges. And this one is the superimposed NYSE margin debt. I just copied it and put it here next to each month. And so it was 580.9 billion, and the total FINRA has is 627.4 billion. So the NYSE is the majority of the margin, but we could see there's a little bit more in other exchanges. Now, they did update their figures. It increased from 627.4 billion to 642.8, which is a new record high. So when the NYSE updates their last number, I would imagine it's going to be somewhere in the 590 billion range. All right, now I wanted to update the oil. The oil price continued to move higher. It moved higher to $66 last week, and then it peaked. Now it's down to $64. But as it moved up to $66, the commercials added 7,000 more net short contracts. So we can see it's increasing. It increased from 732,000 to 739,000. And I don't have the chart here, but I wanted to let you know the long-term chart is that in 2014, when the price of oil was 105, mid-2014, the commercials held about 500,000 net short contracts. That was it. And then it crashed down to $30 in the beginning of 2016. Now we're at 739. We're 239,000 more. So even though we could see this increase, I actually believe at some point in time, the oil price is going to correct. Now, I decided to check out what was going on in the silver market because I think we're going to continue to see a higher movement in the price of silver. And why do I say that? Well, this is the net short commercial position for silver, and it actually fell. It went from 50,000 net short down to 41,500. And if we go back here, this is when the price peaks there and in here, and it's actually September 2017. And if we look at this chart, the price of silver in September peaked at about $18.20. And at that point in time, the commercial net short position was 84,700 short contracts. And that's right here. That's about right here. You can see there's the 80,000, 87,000. So as the price sold off, then the commercials liquidate their positions and they fall. Now, when the price of silver, and let's say December 11th, when it fell to a low of 1570, the commercial short position had declined, gosh, nearly 70,000 contracts to 18,600. And of course, as the price increases, so does the net commercial short position. Now, the reason why it fell from 50,000, as was shown in the previous chart, down to 41,500 was this sell-off right here. So that's why the commercial is at 41,500. But if we go back, we could see that the peak here and the peak here, we've got a lot more room. Now, these are just short-term. I'm just looking at what's happening short-term to get an idea of where silver is going to move. And traders look at this information. People who trade mining shares or trade the SLV, they look at this and they consider what the commercial shorts are doing, because there is a cycle. But I do think we're going to see higher silver prices. I don't know how long they'll go before they peak, but all this here, these commercial short positions, they won't mean anything in time. When the markets crack, when the oil production really starts to decline, and we start seeing serious issues where banks go under, I mean, it gets really bad. This won't matter anymore, because people will then be looking for where to protect wealth, and it's going to be in silver and gold. So I get back to the last chart. And if you saw the charts about the leverage, about the disposable income, the wealth, the consumer confidence, we're already moving up to these extreme levels, but we can continue to do that because you don't know how much higher they can go. But we're about right here. We may see a higher movement, but I do believe we're going to see much lower. I do believe the market's going to crack. And when that happens, we will see the oil price fall with it. Because economic activity when it's deflationary, it will pull down the price of oil. It will pull down the price of assets, commodities. But even though we may see a small correction in the precious metals at first, they're going to turn around, because that's happened. That actually happened right here in 2016. When the Dow Jones fell, we saw a huge movement in gold, as well as gold ETF flows, and silver. Their prices went up. So we could see a small correction with everything as all the markets fall with gold and silver, but they will stop and turn around, because there really isn't much for people to protect with. And if they're protecting from this kind of leverage, we're going to see massive movements into gold and silver. So thank you again. Please consider checking out my newest videos that are coming up. And if you would subscribe to my YouTube channel, I thank you very much. And you all have a good day.